So it is March 18th, another Tuesday on us. And what's going to be interesting about today's thing, this is like my third recording so far today because I didn't like how it was rolling. I got to think, the mess is going to end up the same. I'm going to give you really the news. So we've got Empire State Manufacturing came out yesterday, way off of what was anticipated. Significant difference. Then you've got retail sales. When you look at that, look at the prior number, down 1.2%. It was revised from a 0.9%, so down 0.9%. So they're expecting it to drop 0.9%. It literally dropped 1.2%. So that's pretty big gap from what they're anticipating. I know we're talking about that small of a percentage doesn't seem like a lot, but it's huge when we talk about the size of what that particular part of the economy is. And then we've got the new reading that was supposed to be as forecasted at 0.5% up. It's actually up to 0.2%. So it's not as high as they anticipated. So that's a pretty big swing. Then you take out auto, and it was exactly as they forecasted it. So interesting stuff. We start looking at that today. We've got housing starts. Housing starts are up from where they forecasted it. They're up from where they were read last time. Building permits looks like they're up as well. Not a lot, but from our last reading, but they're down from what they forecasted they would be. Industrial production is up. Capacity utilization is up a bit. So it means people are, they're not using all their capacity, but quite a bit. This week we had the Fed meeting is coming up tomorrow, and what a lot of people are thinking, or at least they're waiting to see, is what the Fed might hint towards with quantitative tightening. And what is quantitative tightening? Well, let's look back at these charts. We've talked about these a lot over the last couple of years. Actually, I started doing this because of COVID. COVID is what drove me to start doing these videos, so I can explain to the whole world what's happening in the market, because it was hard to explain what's going on to just one person at a time. There's so many people we were working with trying to get locked. So quantitative easing was what happened all the way back with 2008. So we're showing you the Fannie Mae 5.5, or excuse me, the Universal Mortgage-Backed Security 5.5, all the way back to 2008, and what it was trading at that time. Oh, this is going to be a little bit interesting to try and drag this so we can see all of this, because I want to get all the way back to 2008 right here. Then they announced quantitative easing. It jumps because they announced that the Fed's going to dump a bunch of money in there. They start quantitative easing here. So all this money went in. It's hard for you guys to see. Let me see if I expand it so you can see what I'm talking about here. So all the money went in from here to here in one day. That much movement in one day was all traders dumping money in based on what the Fed said they would do, which is we're going to take money from the U.S. Treasury, we're going to move it to the Fed, and we're going to invest it all over into our economy, which is in a way into our economy by putting into the mortgage-backed securities to allow people to borrow, put a bunch of money in there, increase the supply. The demand was low back then because remember, a lot of people just lost their houses. So you didn't have as much demand, so it's pushing rates down. High supply, low demand means lower cost. Well, then because of that, money went in, then the Fed started dumping money in at this point, and that's all quantitative easing. This is the Federal Reserve dumping in $8.9 trillion over this window of time to here. Then this is quantitative tightening. That means we're not going to put more money in. We're not going to reinvest any of the interest that comes off of it. We're going to cut all this back. Now, they tried this quantitative tightening back when, really right around when Donald Trump got elected in 2016. Look at this. This is 2016, election of the first administration with Donald Trump as president. Quantitative tightening was started. They had what they called the taper tantrum. They started putting it back in. We got COVID, and COVID put another $1 trillion back in, and it just went out crazy until October of 2021, and that fell off into quantitative tightening. And this is what we've experienced with the quantitative tightening. We found a bottom where they felt that was the value of the security, where it was worth more than where it was at that time. So they started investing capital into it. Then we got to a point where the jobs reports came that from the administration at the time saying we're creating all these jobs, look at how amazing we are, and really all they were doing is putting people back to work post-COVID, and all these lies about the jobs were coming. And then the real job report came out saying there's really not much happening in the job world, and a lot of money flooded right back into bonds. And where did it stop? It stopped at this level where the value was the day they announced quantitative easing. It fought back and forth again, back up to a point in September, and it stopped at the end of the day's trading of quantitative easing announcement. back down in here. We're back up in this point. We bounced right off of the announcement of quantitative easing, and here's where we're at right now, waiting for the Fed to address us tomorrow. Now, what kind of movement is that going to give? I don't know. He right now, the whole world's staring at him, waiting for something, some sort of idea of what's going to happen. And there's a crazy idea that they're going to, at least this is what I believe. It's crazy. It's not, I don't know, that people think, well, if they back off of quantitative tightening, maybe they can put more money into this and then it'll bring the rates down. True, it could if they start dumping more money into it, but what's that going to do to the cost of housing? So many people sitting here wait for the rates to go down. One, there's a lot of people sitting on the sidelines, an enormous amount of people sitting on the sidelines. I talk to so many people every single day asking when are they going to go down? Because when they go down, I want to be able to jump in. How many people are wanting to do that? And when that happens, what's going to happen to the price of the houses? If these rates do drop 1% from where they are today, so let's say it's mid sevens, drop down to mid sixes to be a real estate investor. You know how many people are going to jump in? No, there's going to be a few people waiting and saying, oh, can it go lower? It's going to get lower. That's those same people that sit there at the craps table. So I'm going to play one more round. I'm going to play one more round. They lose everything. Those that sit there and wait are going to lose. Those that sit here and wait for the rates to drop are also going to lose because the price of the houses have already been proven to go up approximately 12% for every 1% drop in interest rate. You're paying for it anyway. So if you're waiting for that to get you in the game, you're still going to have a hard time making the deal work because you're paying more for the house. Now, even if you still make the deal work because that rate is over a larger purchase price, and it makes it work a little bit better on your cash on cash return, you're still paying more. So I don't know what to tell you guys. If you're waiting on that stuff, I think you're waiting for something that may or may not happen. If it does happen, you're just going to end up getting penalized for it anyway. There's a tax that comes. Either way, you're going to pay for it. Watch for deals, jump in the deals, get that 30-year fixed, ride that sumbitch out. Don't worry about what the rates are going to do and focus on the next deal. That's it. That's how you become successful as a real estate investor. That's a simple formula. But people think that there's some sort of magic. I had an assistant of mine years ago. Just after she got out of high school, she said, boss, life is hard. I need the cheat code. Told you found it. Because what do you mean? That life is hard. That's the cheat code. People are so busy wandering around in here in this one spot looking, there's got to be a code here that's going to get me out of this maze and make me a billionaire overnight. It has happened to people, yes. I'm not saying it hasn't, but that's a very, 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 very small sliver of the population. We're talking about 7, 8 billion people on this rock. Once you understand it's hard, real estate investing is hard. Wrapping your head around the fact that it doesn't always have to be cash on cash returns sometimes can be hard. But just being focused and moving forward day after day after day, you'll end up in a spot someday where you're like, holy crap, that was hard, but look what I got. But you got to start. And you got to start by not sitting here waiting for the rates to go down. I'm sorry. Or shopping around for who's going to give me the best rate. That 8% ain't going to matter shit for you. It really isn't. Get somebody who can help you stay focused on your business. Talk to you on Friday.